Thank you for watching this YouTube video. I'm Pete Stolzers and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded two other videos that I think you're really going to enjoy. Stay tuned, we'll see you soon. The market's been closed for about 2.5 hours. It is Wednesday, January 20th, and that means that it is time for the weekly swing trading video. Hello, traders. If you're watching this video on YouTube, know that I produce it on Wednesday nights and I release it on YouTube to the public Saturday so that my members have a chance to get into the trades that I highlight. Please continue to watch if you want to learn how to trade. There's lots of great educational content. I show you how we find the trades that we're entering. I show you why the trades make sense and all of the check boxes that are marked to make sure that we have the highest probability for success. One of the main things that I see novice traders do wrong is they are oblivious to the market. Market first, market first, market first. You know that that's how I start all of my videos. Right now, we had a market that rallied to a new all-time high. I was looking for this move. We're positioned for this move. I figured that the inauguration would get us one step closer to the $1.9 trillion stimulus bill. Also, we have mega cap tech earnings on deck. They're going to start reporting next week. I feel that the market will be very stable, very solid through January, and we could even see a blow-off rally, perhaps as high as SPY 400. Am I long calls like crazy? No, I'm not. I'm actually very cautious, and I have good reason for being so. I'm going to show you why right now. If we take a look, this is a chart of U.S. investor sentiment, and you can see right here is where we're at currently, 54. If you take a look back, you can see some other spikes. Most notably, last year about this time, sentiment had spiked, and we can go back to 2018 and see that it was really, really high back in 2018, January of 2018 to be specific. So we're going to pull this chart down. This is margin debt. This shows you how leveraged investors are. Look at this. We are near a peak. Well, if we take a look back, you can see that we had a peak here, January 18th, January of 2018. We can go back. Look at that peak right there before the financial crisis. That's right about where we are now. Look at this peak right here. This was the tech bubble back in the year 2000. Very, very high level. That means be careful. As good as the market looks, there could be a problem. This is a chart of the SPY. This is not the current chart, but you can see beautiful upward sloping channel, nice and tight, and then we get a breakout to the upside. This is a bullish climax. This happened to be in 2017 heading into January of 2018. Look at that blow off rally. We could see something similar right now. I'm going to put up another chart. This is a chart of the VIX. This is exactly what the VIX look like. VIX is a measure of fear. It measures option implied volatilities, and you can see how premiums had continued to collapse right into January of 2018. Everything looks beautiful. We got bullish sentiment off the charts. We have VIX near a historic low. Markets going gangbusters. Everything's peaches and cream, right? Not so. We're going to take a look at a weekly chart here. And you can see if we go back, I've overlaid the Bollinger Band so that you can see how they come into play. And I'm going to go back to 2018 because we can take a look at what happened. There's that blow-off rally right in here, and look at how extended prices got. So mind you, this is a weekly chart, and then look what happens. We go from SPY 290 approximately all the way down to about 250, let's say. That is a big correction. That's almost a 20% correction. Look at how quickly it happened. And that is the point that I want to drive home. because everything looks fantastic one day and it looks like garbage the next. And if you think that you're going to time this and you're going to be able to reel in all of your trades, if you're not a day trader, you won't be able to. If you're a swing trader, you're going to wake up one morning and go, oh my God, what happened? I urge you, if you're a short-term swing trader with lots of leverage, this is a time to be super, super cautious. And look at how quickly, this is 2 weeks time period, the S&P 500 fell 50 points, more than 20%. The table is set for a similar move. Look at how the market is riding the upper edge of that Bollinger Band, and then wham, it corrects very, very quickly. Now we're going to fast forward and we're going to take a look at where we are currently. And you can see how we've got this upward sloping trend line, and now we've breached through it. Now this might not look like what we saw back in 2017, 2018, but we're getting pretty doggone overheated. And you can see how once again, we're riding the upper edge of that Bollinger Band. Let's flip to a daily chart. And here we can also see we're riding the upper edge of that Bollinger Band. I'm going to put up a trend line here, and I'm going to connect the dots. And this data point bothers me, but every platform has it. This is a bad data point, so you can ignore that big, this is a bad print. But anyway, you can see the upward sloping trend line, and now we've broken out through it. We could get a couple of more weeks of really bullish price action, and when it happens, boom, boom, boom. Everybody sees the breakout, new all-time high. Everyone gets super, super excited. Bullish sentiment is already sky high right now. Let's take a look at where the VIX is currently. And you can see it's near the lows of the year. It's very, very low, in fact. Let's go to the weekly chart, and you can see how it's been bottoming out right here. Now, this is where it was last January. Very, very low, no fear, no problem. And then we had the coronavirus. So right now, no one is pricing in any surprise to the downside. Just like last year, they weren't either. What could it possibly be? I don't know. Is it the new mutation of the virus? All I know is that when you get everybody on one side of the boat, it has a tendency to flip over. And right now, everybody is super, super bullish. And when the selling starts, that's when they all hit the exits at the same time. And that's what gets the sell programs clicking, and it feeds on itself. And that's why these moves happen so quickly. We're going to play it safe. We've got some excellent positions on right now. Our bullish put spreads are expiring in the next couple of weeks. I've got a couple of trades that we'll look to put on our terms. Now, the one thing that we didn't see in those previous charts was a chart of the PE ratio at the time. Right now, PE ratios are at 40. 17 would be kind of a normal number. They are at 40, and a rebound is priced in Q1 like nobody's business right now. I think that is setting up for some type of surprise event. I don't know what it is. I do know that Janet Yellen, the Treasury Secretary, was talking about how she favors raising corporate tax rates. I hope they keep that rhetoric to a minimum, at least until the economy starts to rebound from the coronavirus. Yes, the vaccines are getting out there, but it won't be until May, according to most experts, that it has a material impact. So we've got time, and this supposed economic rebound has been delayed and delayed and delayed and delayed. Now, China is back on track. Their economy is clicking. They could have 6% growth this year, but know that they've got 28 million people on home quarantine. They've got the coronavirus starting to spread there again. Is it horrible? Is it like it was a year ago? No, it absolutely is not. And they vaccinated 10 million people. So apparently they have a vaccine already. But I'm telling you that there could be some surprise event. We don't know what it is, but with stock valuations at this level right now, I'm seeing a lot of stocks go parabolic. I know that they're not going to be making money for quite a while. These include airlines, they include restaurants. They're trading at huge valuations. Maybe it's a credit issue that starts popping up. I don't know what the event might be. I only know that right now the surprise component in the market favors the downside because perfection is priced in. And if anything happens that's not perfect, that's when we get some selling. So we're going to err on the side of caution. We're going to take a look at our current positions. Then I'm going to show you how I found a couple of new trades that we're going to try and enter today, and we'll call it a night. So let's move forward. Here are our current trades, and I'm going to cover SPOT right off the bat. So I'm going to go to the chart. I'm going to take off the Bollinger Bands. We don't really need to see those, and they kind of cloud up the chart. SPOT, S-P-O-T is a stock that we put on. I love this downward sloping trend line that was violated to the upside. That is a bullish flag formation, typically very good. Started to have some follow through. Stock really rallied hard. And then the bottom fell out on news that Apple was going to be getting into the podcast business. That's something that SPOT has invested heavily in. Market did not like that news. So it sold off. It breached 325, which was our short strike price. You know this from the video that I sent out Monday night. I said bid $1 to buy that spread back in. So we were buying the January 29th 325 puts and selling the 322.50 puts, and we were paying $1 to buy that spread back in. We were able to execute that trade today. I was filled in my model account. Everybody in the chat room said that they were filled. The stock rallied up to 337.50 today, so 12 and a half points out with a week and a half left to go. They were willing to let us out of that trade for $1. We lost 50 cents on it. Now we put the trade on for 50 cents. That would have been a 25% return. We lost 50 cents, so that was a 25% loss. We also have 3 trades that are going to expire this Friday. So first, regarding SPOT, we did release some margin. Now we lost $250 on that trade because I did 5 contracts in the model account. So right now we have $2,750 available to trade. And we've got 3 trades that are very, very likely to expire this Friday. AXP is one of them. You can see the stock has been a powerhouse. Just rally, rally, rally. We were leaning on that breakout right there. Look at the stock go right now. That position is in fantastic shape. We are short the 115 puts. We're long the 114s. That is going to be a 25% winner for us. And you can see that 114 strike is all the way down here. In 2 days, is this stock going to fall almost $15? Doubt it. I think that is as close to money in the bank as you can get. Another one that's going to expire this Friday is J&J. J&J, we're short the 155 puts and we're long the 152.50 puts. The 155 puts are all the way down here. And currently the stock is at 162.41. Nice and stable. 2 days to go. I think that's a slam dunk for us also. The final trade that we have on is Texas Instruments, TXN. There we are short the 165 puts and we're long the 162.50s. And right there was the horizontal breakout, and that's what we were leaning on. That also is in great shape. $8 with 2 days left. I think we're going to be in good shape. Semiconductors were actually very strong today. So we've got 3 trades that are going to produce a 25% return. We lost 25% on SPOT. So net, we're going to have 2 trades that produce a 25% winner for us. So let's continue to take a look at some of the other trades that we have. We're going to go out to the expiration, January 29th. That is a week from this Friday. So we have a week and 2 days, and then we're going to have another 3 positions that will come off, hopefully expire worthless. You can see here that Lyft hasn't done a whole lot of anything. It's compressing in a very tight trading range, and we're leaning on this horizontal support level right here. It's in great shape. We're short the $45 put all the way down here. We're long the $44 put. Really nice looking trade. NET we put on last Friday. This stock is continuing to move higher. We've got a nice upward sloping trend line here. I'll put up the major moving averages, the 200-day, the 100-day, the 50-day. You can see where they come into play. Not really a factor here. The 50-day comes into play. We are all the way down here on NET. We're short January 29th expiration, the 7250 puts, so we're right in here, and we're long the $70 puts. That's a 50-cent credit. Stock's in great shape. This stock could even challenge the all-time high if we get that market melt up that I think might happen. So we'll continue to go down the list. We'll take a look at Walmart. Walmart is the third one that expires on January 29th. We are short the 143 put and we're long the 142 put, and we did that for a 20-cent credit. 1, 2, 3, 4 lines of horizontal support right here, right at our short strike price, and the stock today rallied above the 100-day moving average. It closed above the 100-day moving average. You can see the 100-day moving average comes into play at 144. We had a little bit of a dip in the stock, not something that could have been predicted. The CEO resigned. That's uncertainty. Market doesn't like uncertainty, but after assessing the news for a couple of days, the stock has been able to bounce. The earnings should be excellent. There's one thing that all of these plays have in common. It is a hidden statistical edge that we have been working, and that is that these stocks have a tendency to rally into their earnings announcements. More than 75% of the time, they rally once they get inside of that 2-week window. We're also using that to our advantage. So we've got lots of check boxes marked. The other trade that we have on, it actually expires 2 weeks from Friday, is Nvidia. Take a look at Nvidia. This stock is going nowhere fast. It carries a lot of option implied volatility, and it's herky-jerky. It does move around. You can see how it was below the 100-day moving average. Did I panic? No. The stock is right back above the 100-day moving average right now. Our bullish put spread is all the way below this point right here. We are short the 497.50 puts. We're long the 495s all the way down here. So we got lots of cushion. We've got 2 weeks and 2 days to go on that one. And we have a bullish bias for the stock heading into the number. So we've got all those factors working in our favor. That's a review of all of our trades. If everything works out well, next week we're going to have 3 additional bullish put spreads that expire, and we'll have had a really nice first month. We'll have the 2 winners net this week because we had 3 winners and 1 loser. So net, we were up 2 winners this week as far as I'm concerned, and 3 winners expiring next Friday. That would give us 5 really nice bullish put spreads that expired worthless in the month of January. Things are looking pretty good for the start of the year. So we want to continue to build on that success, and we do not want to take unnecessary risks right now. The only way I want to put a trade on right now is if we can do it on our terms, and the stock has to look super, super good. So what's catching a bid today? I'm looking for breakouts. I'm looking for stocks that are rallying into the number, and we're going to get right to the trades now. So I'm going to show you on the scanner. You can go in and take a look at stocks that rally into earnings. This is your list right here. If you're looking for very short term day trades or swing trades that you can hold overnight, all of these companies will announce in the next 2 weeks. So you can see how earnings are really starting to ramp up. Now, when I went through the list and I looked for them, so many of them have gone parabolic. The train has left the station. in addition to the sentiment indicators and the Bollinger Bands and the VIX and the dollar margin that's being used by investors, in addition to all of that information, I know that when it's really hard for me to find good bullish put spreads, that is a gigantic warning sign. And I actually had a couple of bearish trades that I liked, some bearish call spreads that I'd considered, but not with the market making a new all-time high. Maybe I'll show you that at the very end of the video. Last year in February, the very first time that I had done any bearish call spreads was just before the huge market decline that we had on February 24th. So I think the table is set for us right now not to have a huge correction like we had a year ago, but to see some selling, get that blow off rally in the next couple of weeks, get everybody super extended, get everybody super optimistic, and then the rug gets pulled out. I want to be on the sidelines when that happens. There's a chance maybe we buy some puts, but I'm more interested in letting that market correction happen, and then we start looking for really nice bullish put spreads to put on. That's how I see the first quarter unfolding for us. So that is one list that you can use. Now, I didn't see anything in here that looked particularly attractive, and with so many companies announcing earnings in the next week or 2 weeks, I don't have enough option expirations that I can leverage. But there's another search that I can use. Strong after earnings. This is another really nice one that I can use to find opportunities after the earnings announcement. And there's one stock that hasn't hit this list because it just announced earnings today. And so I went into after earnings. It will be on this list from this point forward. Netflix. Netflix really hasn't been doing a whole lot of anything, and this is going to be our first trade. You can see how it's kind of been chopping around, waffling around in a fairly tight trading range, but now it has a bona fide breakout to a new relative high. We'll zoom out very quickly so we can see that, and we'll use the crosshair tool right here. You can see how we're clearly through those highs. We've got some escape velocity, if you will. Look at that volume right there. So I like Netflix. I think Netflix sets up well for us. Do I want to buy Netflix here? Absolutely not. I want to go as far out of the money on this baby as I possibly can. And if I look at this peak right here, I want to get as close to that as I can, but still have a chance to get some decent premium in. So I'm going to have to go down about to the 550 strike price. Do I think that Netflix is going to retrace back down to this breakout in the course of the next 2 weeks? I don't. I think that it's shown that it wants to move higher. The news was very good. They added lots of subscribers. That's what analysts were really looking for. They were wondering if all the competition was going to eat into the Netflix customer base, and it didn't. So with this kind of volume and this type of breakout right now, I believe Netflix is going to hold up very well. So what we're going to do is we're going to be looking to sell options inside of 2 weeks. So that means we're going to go to the February 5th expiration. We don't want to go out farther than this because if the market has a blow-off rally, we're probably going to be reeling in a lot of our bullish put spreads because we want to be in cash when that happens. We don't want to be vulnerable. As I showed you, in 2 weeks period of time in 2018, the bottom fell out. I can show you similar that happened about 4 months ago in September. These moves happen very, very quickly. So we're going to go down to the 550 strike price. And we're going to click on that bid. And we're going to click on the ask of the 547.50s. So let's review the trade here. You know that there are $2.50 between the strike prices. And when we have $2.50 between the strike prices, that means that we want to get a 50-cent credit. NFLX. Sell the February 5 expiration. We're selling the 550 put. We're buying the 547.50 put. We're doing that for a credit of 50 cents. You can see that currently that spread is a negative dime bid offered at 110. I think we might be able to get 50 cents for this. We're right in the middle. If this stock pulls back just a little bit, let's say that sellers come in a little bit tomorrow and they test that bid and Netflix pulls back just a little bit, even $5 probably will get us filled on that spread. I like it. If we get that pullback, fantastic. I will do that spread for a 50-cent credit. Both of these trades that I'm going to show you tonight, if we are not filled by the close Friday, cancel the order. These are very short-term option trades. We must get filled immediately. If we do not, we are not going to be out there flapping in the wind. Cancel them. Because if we were filled Monday or Tuesday or Wednesday next week, time decay would have started eating away at those options, and the only way we would get filled then is if the stock made a considerable retracement. We don't want that risk. We'd like to see it pull back a little bit tomorrow, get us filled, and then it continues to grind higher. That's the first trade that we're going to look at doing. Again, post earnings plays are fantastic. We want to make sure that these stocks have that escape velocity that I mentioned. Nice big horizontal breakouts, big gaps. These gaps tend to hold for quite a while before they're retested. Even when they are retested, they usually hold. This is the type of setup you want to be looking for. You are going to see more and more stocks hitting that strong after earnings list. And this will be an excellent, excellent source for you to sell out of the money bullish put spreads. So let's take a look at the next candidate. I just love this breakout. This is a great breakout. You can see how we have this horizontal compression here. Stock is going nowhere. This is Google. Decent volume today, breaking out to a new all-time high. Love it. Take a look at the longer term chart here. We'll just zero out. You can see that compression more clearly and that nice distinct breakout. This train has not left the station yet, but we do have earnings coming up, so we need to tread cautiously. If I hover over the E, you can see February 2nd is the earnings announcement date. So I'm going to click on trade and we're going to see which options we have available to us. In this particular case, we only have the January 29th expiration. Obviously, we're not going to sell anything that expires in 2 days because we'd have to go right at the money on this one. But on the January 29th expiration cycle, we've got some choices. So this trade will expire in a week and 2 days, very short-term trade. If I take a look at where I would want to sell a spread on Google, I've got to come all the way down in here. Now I could use this high right here as support. You see it kind of comes into play right there. 1800 would be even safer. If I hover over this candle, you can see the high was roughly 1810. If I hover here, you can see that that high was roughly 1810. So for those of you who might be selling other bullish put spreads, keying off of that 1810 price, it sure works. No issue there. I'm going to play it safe. I am going to put an order in to sell the $1,800 puts and buy the $1797.50 puts. And because we have a $2.50 difference in the strike prices, we have to get a 50-cent credit for that. And we're going to do that good till Friday, meaning if it's not filled by the close Friday, cancel the order. This is going to be a tough one for us to get filled on, and that's okay. If we don't get filled, we're erring on the side of caution. Google tomorrow would have to pull back a little bit on the open, then we would have a chance to get filled on it. If that doesn't happen, we're probably not going to get filled even on Friday because then we're only 1 week away from option expiration. This stock does not have a tendency to rally into earnings, so we don't have that working in our favor. However, this breakout is very significant. So I like the price action today on Google. That is going to be our second trade. I'm only going to have 2 trades this week. I'm not loading up. We've already got a full boat, so to speak. We have enough room to do 2 trades, so we're going to try and put on 2 trades. Now, this Friday, I showed you 3 spreads are going to expire. That means that we'll have lots of room next week. We'll have room to put on some more trades. I don't think I'm going to do it next week unless I see something really, really compelling. So I'm going to err on the side of caution. I've shown you why I feel the way that I do. Eyes wide open. I'm always aware of what's going on in the marketplace, and I'm always aware of the risk. If I were a swing trader who is also day trading and I only had to worry about my account, I could go balls to the wall, knowing that if the market started to fall apart, all I'd have to do is hedge myself and short some S&P 500 futures. And I could do that instantly. I can't do that with all of you because many of you cannot watch the market during the day. I will not send instructions during the day that all of you can't participate in. The only way that I update positions is after the market close when everybody has a chance to watch the video, everybody has a chance to put the trades in. We all have an equal opportunity the next morning to get that trade done. It's very difficult for me, but it gives us all a very level playing field. So I had mentioned to you that I had a couple of other stocks that were coming up on some searches, and I was looking for just some bearish trades and considering the possibility, since I couldn't find anything on the long side, what might look good on the short side. Well, I went into my bearish list here, and then I went into week after earnings. And I also ran a custom search, and you could see JPN was one of them. I think that a 142.50, 145 bearish call spread for a 50-cent credit, that certainly could work well. Look at how the stock is backing off after announcing earnings last Friday. I've mentioned to you that a lot of these stocks have run super, super hard, and I don't get it. Banks, they're going to struggle to make money in a low interest rate environment, and it's going to stay that way for a very long time. We've got the unemployment numbers starting to really creep higher with the coronavirus shutting down most states. That's not a good backdrop for banks at all because you start to get into credit concerns also. The reason that they've rallied is because of the stimulus checks, which, oh, by the way, I don't think that Democrats are real gung-ho about major financial institutions making money. They're the enemy, if you will, and so we can expect increased regulation. There's been talk of capital gains taxes. These are all bad things for the financial sector. So they've rallied. I think they're going to be relatively weak. Now, one stock in particular stuck out to me, and that's Goldman Sachs. And you can see how it's had a really big rally. Now, I've talked about upward sloping channels. Look at how nice and tightly defined this upward sloping channel is right here. And I'm going to draw those tops in right there. It actually can extend back in here. And then you've got your lower channel right in here. This is a beauty. I mean, it just conforms. This is not perfectly drawn, but you can see the channel, and there's your buying climax. Now, all of a sudden, we've got some pretty heavy selling after the number. Let's put up the HA analysis. Green bottom, flat, green bottom, flat, doji, doji, flat, red top. This is a HA reversal. So I believe that these stocks are going to be in trouble for a while. I think that you can fairly safely on Goldman Sachs sell a 307.50, 310 bearish call spread for a 50-cent credit. You would need to wait for a bounce. I would not rush in and force that trade. You're going to need a bounce to get that filled, but I think that spread looks pretty decent. Okay, well, why aren't we doing it, Pete? Because the market is still making all-time highs, and we could get a buying climax. So if you go and put the Goldman Sachs trade on and we have a buying climax and Goldman Sachs gets into trouble, don't ask me what you should do. You know I didn't do the trade. It looks attractive to me right now. If we had a blow-off rally, and I suspected that the backside was going to be very fast and nasty, yes, I probably would look to Goldman Sachs to buy some puts or maybe JPM. Always important to look at both sides of the market. Then you can be truly objective about what the heck is going on. That's another mistake that novice traders make. They only look at one side of the market. It's kind of like playing chess. Novice chess players, they don't watch what their opponent's doing. They only care about what they're doing. And ultimately, they miss what their opponent is doing and they lose the game. You've got to see both sides of the board. You've got to see both sides of the market. So eyes wide open, high risk right now. Keep your trades to a minimum. We've got 3 spreads expiring Friday. We got 3 spreads expiring a week from Friday. We're going to go to the sidelines in February and we're going to see if we get that market dip that I'm expecting. Before then, if you're super short term and super nimble, could get a nice little blow off rally in the next week to 2 weeks. So we'll be participating in that rally in the chat room. But swing traders, be cautious. If you like this content, please give it a thumbs up. Make sure to subscribe to this YouTube channel and turn on your notifications so that you don't miss any of these videos. I can do them at any time. If I've got time and I see something compelling, I'm going to do a video. Good luck with your trading. Thanks so much for watching. Thank you for watching this YouTube video. I'm Pete Stolzers and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.